You might have heard the market's been a little bit shaky lately.
The Dow Jones Industrials just lost all gains for 2018.
The largest single-day point drop ever.
But just because it seems like everybody else is panicking doesn't mean you need to. The Dow Jones dropped over 1,800 points in 2 days of trading, which sounds like a huge number, especially if you're someone who's still feeling scarred from the financial crisis of about a decade ago. The Dow Jones is an index. It tracks the stocks of 30 large US companies. We're talking Apple, McDonald's, companies like that. But it doesn't represent the entire US economy, and that's an important point to understand. Just because the market tumbles a little bit doesn't mean we're heading back into the next financial crisis. Monday's decline in the Dow was big, sure, but from a percentage basis, it actually wasn't that impressive. There was a day in 1987 when the Dow dropped by over 22% in one single day. On Monday, it was just a little bit more than 4%. So taken from that perspective, it's not time to completely panic, freak out, and sell every investment you own. The thing about the stock market is it's always on the move. When it's going up, we all feel great and nobody's asking questions. But as soon as it goes down, even a little bit, people want answers. There are a few different reasons the stock market can decline. Sometimes it's just normal. It happens from time to time. Like on Friday when the stock market was down about 2%, that's not really reason to pay too close attention. But on Monday when it was down 4.5%, there's probably a reason when something like that happens. One of the biggest reasons being a strong employment market in the US, including wage growth, which caused a few people to start worrying about rising interest rates and inflation. But at the end of the day, what wage growth means for you, hopefully, is that you got a raise recently, which is a really good time to increase your 401k contribution and keep investing. Nobody can predict where the stock market is going next. Even years ago, people were wondering when the next big crash was going to happen. Even the pros get it wrong, more than you would think. So there's no sense trying to time the market. You're not going to win. When you're investing for retirement, the daily stock market moves are never reason to panic. In 2008, during the financial crisis, the market dropped 37%, which was massive and certainly very anxiety-inducing at the time. But since that point, the market has more than doubled, and we've had 9 straight years of positive returns. So if 2008 had freaked you out to the point that you didn't want to invest anymore, you would have missed out on huge amounts of wealth building opportunities as the market kept going up. And here's the thing, it will go down again. It has to, it's part of the process. It might go down a lot, maybe even 37%, but keep in mind that it will go back up. So if you start selling or trying to time the market, you could very well be out of the market right when it picks back up. And that is a problem for your retirement account. When the stock market is rocky like this, I know it's not easy to stomach, but if you stay the course, it will definitely pay off in the long run.